All right, let's talk about the introduction. The Much of what we're going to talk about in this video is covered in chapter one. I'll start with a chart that is not actually in your book, but it will help you get an idea of what we are going to cover in this class, what's included in the broader field of finance, and the things that we will cover in this class, right? So let's look at the, the topic of finance itself, right? Of course, finance everybody thinks of as managing money, the science or art of managing money, but it is fairly broad, and like all good things, it comes in threes. So the the three major subfields within finance is financial markets and institutions. These are banks, right? There's commercial banks, there are investment banks, these are stock markets. But of course, a market is typically defined by whatever gets traded. So we're talking about a market for financial instruments like stocks and bonds and loans and insurance policies. Um, so and pension funds, etc. Those are all products from in which uh, trade trading takes place in financial markets, right? And then the institutions like banks and stock markets or stock exchanges, etc., are actually um, institutions that allow us to trade in these financial instruments. And of course, then there's the broad field of investments, which is uh, for both um, investors and investment companies. Investment companies would be things like pension funds and mutual funds, right? Which collect a premium or collect your annual or monthly contributions, and they want to make it grow and put it in a safe place for the time when they have to pay out those pensions. Insurance companies do the same thing with the premiums they collect on insurance policies until they have to make payouts. They want to not just keep it safe, but make it grow. Of course, as individuals, we may want to make our own investments by buying stocks and bonds and mutual funds, etc., that we are using for to make our savings grow. So both in institutional and investment, individual context, investments is a field on its own, and then there's managerial finance, right? Managerial finance is basically managing the finances of a business or a company, and most of our focus in this class will be after we build some tools and talk a little bit about investments. Most of our focus will be in managerial finance because as an MBA student, you are getting trained to become a manager, right? And financial markets and institutions, there are financial markets like the stock exchanges, right? There are financial institutions like banks, commercial banks, investment banks, mutual fund companies, insurance companies, etc. So managing those financial institutions is a different type of business than, say, a manufacturing company is. So that in of itself is a fairly broad field. Financial assets are basically those things that get traded in these markets, right? Which are stocks and bonds and futures and options and mutual funds and exchange traded funds or ETFs, etc. Investment, of course, and the first one part is, of course, providing sales and advisory services, right? And, and this is where you'll see a lot of offices um, for basically brokerage houses, etc., have offices, and most of our commercial banks now actually have investment sales and advisory services, where they'll be able to sell you mutual funds and provide you with financial advice. Right? Securities analysis is basically trying to put a number to the value of, say, a stock for a company, right? And it's a pretty high skill job, and it requires a lot of analytical skills, and also if you try to get into that, you will be paid very handsomely. Portfolio management is running portfolios for companies. A portfolio is a collection of assets, and we're talking about financial assets. So you can run a mutual fund, which is a portfolio. You could run a pension fund, which is a portfolio. Again, those are very well paid positions. Then managerial finance, and the things that we will be focusing most on is capital budgeting and capital structure, right? So, and not so much short-term finance, because short-term finance is running day-to-day cash flow operations, and you actually will get a pretty good deal of coverage of that in your accounting course. But capital budgeting is figuring out what long-term projects are good and worthwhile to invest in from a company's perspective, right? And capital structure talks about how to raise money to invest in these long-term capital budgeting projects. What's a good mix of debt and equity to be used, etc. So those are the final few chapters in the book will be focused on these two areas. First few chapters will talk a little bit about financial assets, and of course we are going to be talking about some tools. We'll be learning about time value of money, some of the statistical tools for measuring risk and return. So once we're done building those tools, we will then look about valuing stocks and bonds, and then get into capital budgeting, capital structure. So that's basically what we are going to be doing in this class. All right, now here's a typical way in which these lectures are going to be organized, right? It's a question and answer type of method, the Socratic type. So I'll pose a question, and then I'll take you through the answer in these video lectures. So let's look at this one. While tinkering with miniature horses, Naomi Horse developed an extreme version of a miniature horse, which she decided to name Nano Horse and market to pet poodle enthusiasts. She obtained a state license to breed and sell the Nano Horse. She has managed a successful business for the last 5 years and must now expand her business to satisfy the ever-growing demands for the Nano Horse. Now, Naomi's Nano Horse boutique must establish a larger scale breeding farm at a cost of $250,000. With her personal assets, she had just enough collateral to obtain a bank loan for this investment. Her best friend, Norma Horsplay, and Nathan Horst DeVos are eager to join her business in a partnership and can provide the necessary capital. Right? So a lot of words, but just to summarize it, we have Naomi, who is trying to grow her business, and she's gonna need some new money. $250,000. She's gonna need $250,000. Well, she has that money, but putting it in the business will basically mean she doesn't have any money left over in personal assets, right? But there's other options, right? uh, I said that wrong. She doesn't have the money, but she has enough assets that can be used as a collateral to obtain a bank loan, right? Um, and if she does that, the entire business will remain hers. The other option is that she's got a couple of friends who can join her business in a partnership, and they have the necessary amount of money, $250,000, right? So Naomi then ponders. She's thinking, should she obtain the bank loan, or should she go and get money from Norma and Nathan, her friends? What's your advice to her, right? So, well, Naomi could proceed with a bank loan and keep sole ownership of Nano Horse Boutique because she's the sole proprietor right now, right? However, this will exhaust her credit line and put her entire wealth at risk because of the unlimited liability obligation of sole proprietorship, right? So it's basically there's if the business goes under and the business owes money, well, the creditors can come after Naomi's own personal property, like her house, for instance, right? So that can be risky. Right? It can be risky if she does not experience rapid earnings growth, right? The business may then become unsustainable in the future. Hence, we should suggest that Naomi can enter into a partnership with Norma and Nathan. They can provide the necessary capital and shoulder the unlimited liability burden as full partners. If Naomi is concerned about losing managerial control, she could offer Norma or Nathan a limited partnership where they cede managerial control of the business in exchange for limited liability, right? So you can have partners that have different roles, right? So in a partnership, not all partners need to have unlimited liability as a sole proprietor does. As long as one partner has unlimited liability, the others can assume limited liability, right? So Naomi could say, "Hey, you know, um, give me that $250,000, and if the business fails, you lose that $250,000, but nothing more. You just lose your investment because you only have limited liability. But in return, you let me run my company, and I have total control of how the company is managed, right?" So Norma and Nathan will become limited partners, whereas Naomi remains unlimited partner and the proprietor or manager of the business, right? So Noblehorn, a financial consultant, tells Naomi of yet another alternative. According to Noble, Naomi could form a corporation called Nano Horse Incorporated after filing the necessary papers with SEC, and SEC stands for Securities and Exchanges Commission. Then Nano Horse Incorporated could raise funds by selling shares to the general public. Compare and contrast the corporate form of governance to the proprietorship form. Basically, if you remember, we're talking about going from being a sole proprietor to a partnership. Now we're talking about becoming a corporation. So what are the advantages, disadvantages of forming a corporation? And how would you advise Naomi? Well, forming a corporation is more cumbersome. There's paperwork involved. You got to file, do some, and there's some legal and legal requirements. There's disclosure requirements where she has to make public the finances of her company, and these could become quite burdensome. These laws are there to protect the masses of investors that Nano Horse Boutique can now raise capital from, right? So after all that legal requirements are met, the financial disclosures are done, then and the SEC grants approval, then NanoHorse can sell shares to the general public, and that way can raise a lot of funds. So the disadvantage is that there's burdensome requirements, legal and disclosure. Right? Of course, the advantage is that the NanoHorse now has access to significantly greater amounts of capital, debt, and equity, which it can raise directly from investors. It can raise funds from masses of investors because the corporate form of ownership offers the protection of limited liability. Hence, each shareholder can only lose their investment in the firm, regardless of the extent of the firm's liabilities. The firm now becomes a legal entity separate from its owners or shareholders. One disadvantage for Naomi is that she may need to cede some control of management of NanoHorse to the corporate board of directors. All shareholders of the firm, including Naomi, are now also subject to double taxation of company's profits. Right? So a corporation actually is run by a board of directors, right? And the board of directors appoints the CEO. So Naomi will lose her, sole control of the company. She won't be the sole proprietor anymore. She won't be able to control everything that goes on in the company. Also, all the shareholders, which are owners, Naomi will be one owner. She'll probably have a majority of shares in her possession, but she'll be a shareholder. All shareholders are now subject to double taxation, which means the company actually, forming a company means the reason a company can have limited liability is because, shareholders can have limited liability is because the company becomes a separate entity and legal view. So in the eyes of the law, the company becomes separate from its owners or shareholders. And so because that, the company has to pay taxes on its profits. And then when those profits are distributed as dividends to shareholders, shareholders will have to pay taxes on the dividends they receive. And that's called double taxation. Okay, once NanoHorse Incorporated is incorporated, Naomi considers hiring professional managers to handle the reins of the company. Naomi will only retain a few shares of the newly incorporated business and diversify her wealth with other investments. Right? And this is a good idea. Now diversifying means that she will sell most of her shares, just have a few shares left, then buy shares of other companies. So if this company or any one company folds, Naomi will not lose all of her wealth, right? So that's why diversification makes sense. But what effect would the dilution of ownership have on her operational control of the business? Describe the corporate separation of ownership and management in Naomi. What kind of agency conflicts might this create in NanoHorse? And what remedies would you recommend? Right? So, with her ownership diluted, Naomi will need to cede control of the company's management to its board of directors, whose members are elected by shareholders. Since Naomi plans to retain only a few shares of the company, her influence on the company's board, and hence its management, will be greatly reduced. Because in a company, in a corporation, there effectively is a separation between owners and management, right? The shareholders, most of the shareholders may only hold a small stake in the company. You may have, shareholder who holds 100 shares of a company stock may have maybe one 10,000th of a share in the company, maybe one 1/1,000th of a share of a company. And of course, that shareholder is not going to be deeply involved in trying to run the business, right? Um, but the manager, of course, the manager's job is, you know, with the company. And so the manager, and because shareholders may not be able to monitor the manager's work because shareholders own the company, but the manager runs it, right? And they're two different people, and so that majority of shareholders are either unable or unwilling to wield much influence on the board of directors, and the board of directors appoints the CEO and other top-level managers, right? And these managers can, if left alone, they'll seek to promote their own interests with excessive consumption of perks and bonuses, right? Corporate jets, etc. Thereby, they're acting against the interest of the true owners or shareholders. This conflict of interest is an agency problem. We call it an agency problem because the agent or the manager will act in his or her best interest and not in the best interest of the principal in this association. So shareholder is the principal. Of course, the company should be run in the interest of the owners, but that's not what is happening here, right? So the agent is running the company in his or her own best interest. That's called an agency conflict. And agency conflicts can be quite costly, can be detrimental to the long-term profitability of the company. To mitigate this agency problem, many corporate compensation plans are designed to make managers a part owner of the firm, right? Like instead of paying all of the manager's compensation in cash, well, let's pay them in shares of stock, or at least a part of it in shares of stock, or give them stock options, right? Options would allow the manager to purchase shares of stock at today's price at some point in time in the future, right? And so the company or the manager now has the incentive to run the company such that the company's share prices go up over time. So Nanohorse may structure its executive compensation along these lines, like stock options or grants of share, in order to align the interests of managers with those of its shareholders, right? So now what we're doing is making managers also shareholders, and then they will think like shareholders, will act in the interest of shareholders. So Naomi remembers from her days in college that the primary objective of a corporation is to maximize shareholder wealth. She wonders if this is any different from the goal of maximizing profits for the firm. Didn't that sound a little greedy? What about societal norms? Could a corporation ever benefit the society if it single-mindedly chased profits? What answers can you provide to Naomi so that she can feel at ease about incorporating Nanohorse? Introduce the concepts of corporate valuation using the projections of free cash flows and the weighted average cost of capital. Okay, so shareholder wealth maximization is different from the goal of profit maximization. Right? Due to the time horizon under consideration, profits are usually defined by accounting measure of net income, which is the bottom line of an income statement. Right? Over the short term, net income may be maximized by sacrificing long-term benefits for the firm. And to give you a very brief example, you can start selling assets, pieces of the company, and then for this year, your net income is higher. But of course, those assets would have been used to generate revenue for the firm in the future. So you're sacrificing future years' income by doing that, right? Shareholder wealth maximization occurs when the firm's value is maximized, which is the present value of its free cash flows over an infinitely long horizon. Right, infinitely long because at the outset, a company does not have a lifespan. Right, a corporation can exist forever. So the firm value is actually a present value, and if you're not familiar with that concept, we'll cover the concept of present values the next chapter. But it's the present value of its free cash flows over an infinitely long horizon, assessed at the firm's weighted average cost of capital. So here's how my present value is calculated. Suppose we're talking about free cash flows that you get 2 years from now. What is its present value? It's going to be computed by dividing this with 1 plus some interest rate raised to the power of 2 for 2 years. And we get the discounted value, which we call present value. Right? Here, the rate we will use is called the weighted average cost of capital. And we have a whole chapter devoted towards it later on in the book. What we're discounting is free cash flows. Free cash flows are cash flows remaining after the company has, from the cash it generated this year, it pays off all the expenses, pays off taxes, etc., pays for any capital equipment like machines, factories they might have built, and then if anything is left over, that belongs to the company's investors, which will be shareholders and bondholders, so creditors, right? And that is called free cash flow. So we'll look at the free cash flow, these projections of free cash flows in the future, next year, the year after, the year after, the year after, it goes on. Of course, the timeline is infinite. And we calculate the present value of each of those, the free cash flows, add them up, and that is the value of the company. So firm value, and the share price will depend on the company's value, firm value. So shareholder wealth maximization can only occur if the long-term profitability outlook for the firm appears to be at its best. Thus, the goal of shareholder wealth maximization is forward-looking, to the extent that a firm pursuing such a goal must act in the best interests of all its stakeholders. Not just shareholders, but customers, suppliers, employees, and everyone else it must share its environment with. So, for example, a polluting firm may show enhanced short-term profitability with cost savings and pollution control equipment, but it will lose goodwill, customers, and sales over the long term, thereby preventing it from maximizing the wealth of its shareholders. Another example, a company that exploits labor with inhumane working conditions may only benefit from cost savings over the short horizon, but low labor productivity and the negative publicity generated will prove costly over the long run. Once again, we have a firm that's not trying to maximize shareholder wealth, it's only short-term profits. Therefore, maximization of shareholder wealth is not as greedy and objective as it may appear to the naive eye. Naomi should not let that worry prevent her from incorporating the firm. All right, let's move on to financial markets, the capital allocation within financial markets, right? Basically, you can say that financial markets exist to facilitate the flow of funds from people, savers, to borrowers. And typically, savers and investors and borrowers are businesses. Businesses need to spend a lot of money right now in order to build their factories, etc. And those factories will pay off in the future, and then they can return the borrowed funds with interest. And of course, that's what the savers want. Savers are saving they have excess cash right now. They're saving for the future, and they want to be able to put that money to work so they get some interest on it, right? And so they are willing to lend if the price is right, in other words. And the financial markets just exists pretty much solely for the reason uh, of getting these two together. Without financial institutions, etc., we would have to rely on direct transfers, which means that businesses are selling stocks and bonds or to individuals directly, and then receiving the money in exchange. But you can imagine that the market would be much smaller without the existence of any help. So here, a business that needs $1 million, right, would probably look for millionaires or multimillionaires that can lend them $1 million. They wouldn't really want to approach 10,000 individuals and borrow $100 each from each of the 10,000 individuals, because the cost of doing that on their own is going to be quite prohibitive, right? So we have institutions that are there to help. Some, like investment bankers, they maintain a network of brokers and dealers, and they're in the business of selling stocks and bonds to a large network of investors, right? And they maintain these, right? And these investors are investing in many different businesses. But for a business to do that on their own, it would mean that they would have to maintain a staff of people that sell, and businesses, of course, don't need to raise capital every day. They may want to, they may need an infusion of $100 million now, and then nothing for the next 5 years. So it really doesn't pay to keep a staff at hand that can approach hundreds of thousands of different individuals, which is what the investment bankers and this network of brokers and dealers they have. So they basically help businesses sell their securities, stocks, and bonds in exchange for cash that's coming from this. They take a commission, they work on commission, so they take a cut. But there are basically selling stocks issued by those businesses to these investors, right? But then we have indirect transfers in indirect markets where things become quite opaque. So as far as the saver or investor is concerned, they're actually buying securities from the intermediary. You can think of your commercial banks, your local bank, right? The bank will lend that money probably to local businesses or even other individuals, the money that you deposit. But as far as you're concerned, the bank has your money, right? The bank owes you money. The checking account is actually the securities that are, the account. In the past, you used to have something physical to show, like a passbook, etc. Nowadays, it's basically all electronic. But the bank has sold you financial assets like a checking account or a certificate of deposit, the CDs, etc. And you've given your money to the bank. And the bank then turns around and lends that money to the borrowers. And, of course, gets their stocks and bonds in its own repository, right? But this intermediary actually made this process quite opaque, right? These businesses don't know who the ultimate lenders are, and these investors don't know who the ultimate borrowers are. So that would be your local commercial bank. So that's how the financial markets function. Right. We're going to talk about some other issues here. For instance, let's look at this iInvestor. iInvestor is considering purchasing 1,000 shares of NanoHorse Incorporated upon its initial public offering, right? So some more terms thrown in here. An IPO, or initial public offering, is the first time that a company issues stock and goes from being a private company to a public company. And after the first time, it'll be, to issue stock again, it won't be called IPO. It'll just be called a seasoned offering or a secondary offering. All right, so iInvestor is considering buying some shares. His broker, arranges to obtain 1,000 shares for Mr. Vestor at the IPO offer price from Lehman Brothers, the underwriters of this issue. Will this transaction occur in primary or secondary markets? So this is a little bit different than the previous slide, because there we were looking at direct markets and indirect markets, right? We had the middle part of that last slide was showing you investment bankers, and here we have Lehman Brothers, who's the investment banker, the underwriter of this issue. And that's another term that you should look up in the book, right? Anyways, is this transaction happening in primary or secondary markets? Well, when the company issues stocks and bonds, and investors buy it, that is happening in the primary market, right? How is it different from secondary markets? Well, in secondary market, the issuing company is not involved, right? So if I want to buy shares of IBM today, IBM is most likely not selling stock today, right? Because they only do it when they need some capital infusion that may happen once every few years. So how do I buy shares of IBM? Well, I buy it from someone else who is holding shares of IBM and wants to sell it, right? Well, that transaction, will happen in the secondary markets. That's when IBM itself is not involved. I'm buying IBM shares from someone else who's holding IBM shares, right? And of course, we'll still be going through brokers and dealers in the stock markets, but IBM is not involved in that transaction, and that makes it a secondary market transaction. But right now, Mr. Vestor is buying stock that's being issued by NanoHorse Incorporated, and even though we got a broker, we have an investment banker who's the underwriter, it's still a primary market transaction, right? So Gitcha and Lehman Brothers are simply acting as agents to facilitate Mr. Vestor's purchase of shares from the issuing company. Now, 6 months after the IPO issue, Mr. Vestor decides to sell his shares of NanoHorse. He instructs his broker, Gitcha to sell his shares immediately at the best available price. Is this a market order or a limit order? If Mr. Vestor instructed that his shares be sold for no less than $20 each, what kind of sell order is it placing, right? So first, let's note that 6 months after Mr. Vestor decides to sell his shares, and of course, another investor is going to buy it, right? And not the NanoHorse Incorporated, the issuing company itself. So that means this is a secondary market transaction, right? If you just give them instruction to buy shares immediately at best available price, that's called a market order, right? Um, so with an instruction set at best available price, Mr. Vester is placing a market order. Note that the broker, Getcha Broker, still has the responsibility to sell at the highest bid price quoted in the marketplace, right? So in stock markets, you'll see prices quoted with a bid price and an ask price. And a bid price is a price at which a dealer is going to buy shares from you, and the ask price is the price at which he will share shares to you. And there's going to be a difference between the two. Ask will be higher than the bid, but that is how the dealer um, makes a profit. It's in the business for making money, of course. And but a lot of dealers are acting like market makers, which means that they stand ready to buy and sell whenever there is a need for it. Whenever you want to sell, so there's someone ready to buy, and that is more likely to be a dealer. So, and for that service of providing liquidity, they have this difference between the bid and the ask price. But a bid price is a price at which we can sell to the dealer, and the ask price is a price at which we can buy from the dealer. But your broker, Getcha Broker, still has the responsibility, it has this fiscal duty to sell at the highest bid price quoted in the marketplace, which is the best available price, right? Now, if you say, don't sell it for any less than $20, with an instruction to sell for no less than $20, you're actually placing a limit order where you have a limit set. $20 is the limit, right? And it's a limit sell order. So you have a sell order which has a floor that's no less than 20, right? If you want to buy, you can put a limit order and you're giving the highest price you're willing to pay, right? And that would be a limit buy order, which has a ceiling. A limit sell order has a floor. So it's $20. iInvestor strongly believes that Nano Horse Incorporated's share prices are about to take a dive, and he's already sold the shares he owned. However, he would like to take advantage of his knowledge or belief and sell more shares of Nano Horse now and purchase them back later at a lower price. Explain how we may achieve this objective. We have the process of short selling, contrast long versus short positions in stocks, and discuss the risks involved in each kind of transaction. Is one process riskier than the other? If so, why? Well, the often quoted maxim in the financial markets is to buy low and sell high. Fortunately, stock markets allow us to reverse the order of buying and selling with short sells. In other words, we want to buy low, sell high, but we don't have to do it in this order. We don't need to buy first and sell later, right? With short sales, we can sell first and buy later. Of course, we still want to sell high and buy low. So now Mr. Vester can borrow shares from another investor, it's facilitated by his broker, and sell them at the current prevailing price. But now his loan is in the form of shared stock. In order to repay his loan, he must buy shares of stock back from the market at the price which prevails then, right? And hopefully it's lower, because that is what that's the expectation which Mr. Vester is acting, right? If his expectations realize and the price indeed is lower later, he can profit from this short selling transaction. If the stock price falls, he can profit by buying shares at a lower price in order to repay his loan. But if the stock price rises, he must buy back at a higher price and incur a loss. This form of profit taking can be incredibly risky because share prices can rise without limit, exposing Mr. Vester to potentially unlimited losses. In contrast, with a long position, the maximum loss is limited to 100% if the stock becomes worthless, right? So it's very risky short selling. Okay, Mr. Investor had spent years in trade school, and he remembers his teacher talk about how investing in futures could allow you to take the upside and hedge the downside of a risky transaction. Do you believe that's true? Can futures or forward contracts allow you to take the upside and hedge the downside? If not, is there another financial instrument that may allow you to do that? If there is one, is it costless? Right? Futures do not provide asymmetric payoffs. In other words, you can't get into a futures contract and then only have the upside potential and no downside potential. Futures are useful in hedging other exposures, right? So with futures, you can basically protect yourself from rising prices, right? If you buy in the futures market, you can protect yourself from rising prices. But if the price happens to fall, you're stuck with that contract and you actually will incur some loss. But you do gain this peace of mind, and that comes from hedging. You have the certainty, you've gotten rid of the uncertainty, right? So it's useful in hedging. But there is an instrument that automatically allows us to take the upside and hedge the downside, and that's the options contract, right? But options are not costless. You have to pay something. One must pay a premium to purchase an options contract. Since we are talking about options now, explain the difference between a call option and a put option. Also the difference between writer and holder of option. Can you distinguish the long position from a short position, both in case of futures and options? A call option is an option to buy. We can be long a call by buying the option. You're also called the holder of the option in exchange for an upfront premium, or also known as the price of the option. This allows us to eliminate the downside when the price falls and keep the upside when the price rises. This is possible because the long retains the right to buy and at a predetermined exercise price without an obligation to do so, right? The seller, the writer of the same option, is short the call and does not have an option, right? So both parties cannot have an option because then it's a void contract. Whenever it's in your interest to back out, it'll be in the other party's interest not to. But when it's in your interest not to back out, the other party's it'll be in the other party's interest to back out of the contract. And so if both parties have the option to back out, then it's not a contract, right? So only the buyer of the option has the option, right? The choice to back out. So the seller, or the seller is called the writer because essentially he's writing out the contract, selling it to you. The seller of the same option is short the call, retains no option. He or she collects a premium, but in exchange they get a premium, but is exposed to losses if the stock price rises beyond the call's exercise price. On the other hand, a put option is an option to sell at the preset exercise price. If the stock price falls, the option holder can choose to sell at a predetermined exercise price without an obligation to do so if the stock price rises. Of course, to be long a put, one must pay a premium which goes to the put writer. The seller or writer of the put is exposed to losses when the stock price falls. Hence, the short position bears the risk in exchange for an upfront premium or the put price. Okay, so with this, we'll end this lecture, and we'll be back with the next one soon.